Section 1. The end of easy money. Traditional ways to make more money are changing, and the old paths to a higher income are becoming less reliable. For many years, a person could expect that a good job would lead to steady raises, long-term tenure, clear opportunities for promotion. These assumptions are no longer as certain as they once were. The structure of work itself is shifting. Many companies now prefer to hire specialists for short-term projects, specific tasks, rather than bringing on full-time employees for broad roles. This creates a more fluid, but also more uncertain job market for everyone involved. You must adapt to this new environment to protect and grow your income. The economic landscape is also in constant motion. Markets move with incredible speed, driven by new information, changing investor sentiment. Technology continues to reshape entire industries, making some job roles obsolete, creating entirely new ones. Global trade patterns are being redrawn. Geopolitical tensions are influencing where companies choose to operate and invest. This is not a moment for panic. Instead, see it as a strategic inflection point. The old rules are fading, new opportunities are emerging for those who are prepared. This video provides a clear map for navigating this new terrain, built on public data and verifiable business examples, not on speculation. We draw on insights from global institutions. Source: International Monetary Fund. Source: World Bank. Source: OECD. Guidance from central banks, U.S. Federal Reserve and Bank of Canada. Section 2. The 2026 Macroeconomic Reality. What the data says. To build a sound financial strategy, you must first understand the economic ground beneath your feet. The data from major global institutions provides a clear picture of the environment we are heading into. One of the most watched metrics, inflation, has eased from the dramatic highs seen in recent years. However, central banks remain vigilant. According to official communications from the U.S. Federal Reserve and the Bank of Canada, you should expect interest rate movements to be slow, deliberate, and highly data-dependent. The era of near-zero borrowing costs is over. The cost of capital will remain a significant factor. The long-term driver of prosperity and individual income growth is productivity. Here, the picture is mixed. The OECD and the World Bank report uneven productivity gains, with a growing gap between firms that have integrated new tech and those that have not. Digitally enabled companies produce more value with fewer resources. Geopolitics and supply chains have transformed. Lowest cost global sourcing is giving way to regionalized and near-shored networks. As the IMF and World Bank note, this alters input costs, delivery lead times, and where companies hire and build. Realignment creates new hubs. Demographics matter. Aging rich world populations shift services and workforce size. Younger regions form new markets and talent pools. Understanding these shifts is essential for spotting where future demand for specific skills, products, and services will come from. These are the foundational facts for any plan. Section 3. What this economic data means for your income. Macroeconomic data is not abstract. It has direct implications for your personal income. The central theme: stable, evidence-based opportunities create lasting wealth, while chasing short-lived fads leads to disappointment. Higher cost of capital means businesses are judged on cash flow, not promises. Uneven productivity gains send a clear signal. Increase your own productivity or the productivity of your business. If your role can be automated, your pricing power declines. If you help adopt tech, streamline operations, or enter new markets, your value rises. Supply chain shifts create pockets of opportunity. New jobs in overlooked cities and new markets for small businesses supporting logistics and advanced manufacturing. Demographic changes point to growth industries: healthcare, wealth management, accessible home tech for aging markets, education, digital entertainment, and consumer goods for younger populations. Use predictable, large-scale trends to position yourself on the path of growth. Align your skills with the economy's productive, profitable parts. Pay attention to regional shifts to stay ahead of the curve. The big idea: understand the data, then take clear, deliberate actions. Section 4. The new high earners. Skills with real pricing power. The market values skills that solve clear, measurable problems. Major reports from the World Economic Forum, analyses from the LinkedIn Economic Graph, and research by McKinsey & Company all point to the same conclusion. Generalist roles see slower wage growth compared to strategic specialists. First, deep digital and data skills, cloud architecture, data engineering, and practical machine learning. Second, domain-specific strategy, regulatory compliance, specialized supply chains, nuanced customer behavior. Third, sales and monetization, pricing, recurring revenue, and closing high-value deals. Fourth, systems thinking, design and improve end-to-end processes. Finally, leadership for change, guiding teams through disruption. Make a strategic choice. Build deep expertise in one pillar: technical, domain, sales, or systems. Invest in real, demonstrable experience. Use LinkedIn signals and McKinsey lists to validate demand. Not all business designs are created equal, especially in an economy that prioritizes profitability over speculative growth. The models succeeding now will likely continue to in 2026. They combine strong pricing power, strict margin discipline, and operations that can scale efficiently. The era of growth at all costs is largely over. Investors and lenders demand a credible path to positive cash flow. Service-led businesses start with high-touch services, identify repeatable parts, package them into products or subscriptions, and gain predictable, high-margin revenue. Platforms connect supply and demand without owning assets, optimize transaction margin, and build network effects to scale via technology. Target a specific segment with a specialized, high-value product. Command premium pricing through deep customer understanding and quality. Research: Harvard Business Review, IBIS World, Statista. Margin discipline and sound unit economics beat raw growth metrics. Okay, that covers the three models. Artificial intelligence is a powerful tool, but it is not a magical solution to every business problem. Separate the hype from the reality. Stanford AI Index, analyses from the MIT Sloan School of Management, practical reports from Deloitte and PwC clarify what AI replaces versus amplifies. AI excels at automating routine, rule-based tasks, processing structured data, categorizing information, repetitive document workflows, and basic coding in narrow contexts. It amplifies work requiring judgment, creativity, and strategy. Speed and scale increase, but humans still decide and align to goals. This is exactly the kind of strategic work we do with clients at Trillium BCG, turning macro insight into practical business decisions. For small and mid-sized businesses, the most practical applications are simple: AI chat for common inquiries with scripted handoffs, better lead scoring, cheaper content, and prototype drafts refined by experts. Focus on outcomes, not tech. Ask: will this tool improve margin, speed, or quality? You know, that's the litmus test. Use AI to remove bottlenecks and redeploy time to higher value work. Avoid tool sprawl and novelty chasing. Understanding replace versus amplify turns AI into an income multiplier rather than a costly distraction. Generating a high income is not just about your primary job or business. It is also about making your capital work for you. The most reliable path is consistent cash flow, not hoping for big price jumps. CFA Institute, Morningstar, Vanguard, BlackRock. Research stresses risk-adjusted returns. Evaluate returns relative to volatility and loss potential. Reliable cash flow assets include small rental properties, service businesses on recurring contracts, dividend-paying stocks of mature companies, and niche private lending or invoice financing. Choose rentals in stable markets with solid rent-to-value ratios and understand local economics, population trends, and management costs. Core principles: think risk-adjusted returns. Diversify across asset classes, income sources, and regions. Prefer assets you can understand. Know how they generate cash flow and stress test downside. If you can't explain or model it in a downside, avoid it. Hope is not a viable investment strategy. Focus on tangible, predictable cash for long-term wealth. It takes discipline and diligence, but results are more durable. So yeah, cash flow really does beat hope. Many people, when planning their finances, focus almost exclusively on the upside, how much money they can make. However, building resilient wealth requires an equal, if not greater, focus on the downside. True strategic planning involves a sober assessment of your fragility and a clear plan to build resilience. Most people ignore critical risks until it is too late. Acknowledging and preparing for potential risks separates those who survive shocks from those who are ruined. Income fragility. Ask, how dependent am I on a single client, a single employer, or a single contract? The more concentrated your income, the more vulnerable you are. Debt structure. High interest, short-term, especially variable rate debt can become a burden if rates rise or income falls. Liquidity. Do you have enough cash or easily sellable assets to cover essentials without forced selling at bad prices? Inflation erodes purchasing power and real returns. Consider real assets or inflation adjustments in contracts where appropriate. History is clear. Those with strong balance sheets, diversified income, and a cash flow plan weather downturns. Prepare before the clouds gather. The pursuit of fast, short-term wins can be tempting, but disciplined, consistent action builds durable wealth. In an interconnected world, sustainability and ethics are core to long-term value creation. Regulators, investors, and customers expect it. WEF and UNPRI show sustainability drives performance and resilience. In 2026, tightening rules on data privacy, labor standards, and environmental impact raise compliance stakes. Reputation affects loyalty and purchasing decisions. Firms known for long-term value attract talent, partners, and clients. Start simple. Clear codes of practice, fairness, and transparency. Track basic sustainability metrics tied to costs and risks. Sometimes you forego a quick profit to build a resilient enterprise. Respected, built to last through changing expectations. We have covered major trends, skills, and strategies. Now, your step-by-step playbook to increase income in 2026. Step 1. Start with data, not assumptions. Use public reports, IMF, OECD, LinkedIn, and analyze demand in your specific market. Step 2. Pick a business model that fits. Service first, then productize. Asset-light platform, or high-margin niche product. Step 3. Build clear, defensible pricing. Test price with real customers and confirm unit economics. Step 4. Invest in one high-value skill. Data engineering, contract negotiation, or supply chain optimization. Step 5. Use AI to automate routine work and free time for strategy. Step 6. Prioritize projects and assets with steady, predictable income. Step 7. Maintain liquidity, keep debt manageable, and rehearse worst-case scenarios. Step 8. Operate ethically, stay compliant, and integrate simple sustainability checks. This 8-step playbook helps build a more prosperous and resilient future. The economic landscape of 2026 is not a trap to be feared. See it as an opportunity to be clearer, smarter, and more deliberate about income. The era of easy, passive growth is over. Success won't come from hype or speculative risks. Commit to data-first work. Use trusted sources, not social trends. Build pricing power with deep skills. Choose cash flow positive models with healthy margins. Use AI to multiply value, not distract. Prepare for risk as seriously as growth. Liquidity, prudent debt, and downside thinking. Long-term success rests on ethics and sustainability. A strong reputation and client trust are among your most valuable assets. A structured, evidence-based advisory partner can be invaluable, turning principles into a customized plan. If you want structured, evidence-based guidance to grow income and build a resilient business in 2026, consider joining the Trillium BCG community or exploring our advisory services.